makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning. Happy Friday. Welcome to The Pulse. I'm Tom McKenzie in London. US President Donald Trump could ease trade tensions with his Chinese counterpart Xi Jinping today while determining the fate of TikTok. A framework agreement would shift control of the social media's app's US operations from its Chinese parent ByteDance to a consortium of American investors. They're due to speak, the two presidents, at 2 p.m. UK time after more than a year of negotiations. Bloomberg's senior Chinese economy and government reporter James Mager joins us now. What are we expecting? What are you and the team looking for, James?
I mean, obviously, as you said, TikTok is apparently going to be the primary focus of the talks that are going to happen in I guess, 5 hours from now. And hopefully, I guess, for TikTok or for ByteDance, the owner of TikTok, there will be a deal of some kind which will give it some surety and clarity and how it's going to continue to go forward with its business in America. There may also be other topics of conversation, though. Obviously, Nvidia has been in the news recently with the Chinese both putting an investigation on to their what they claim to be anti-market activities, blocking their exports of chips. There's also the question of soybean exports. The US hasn't sold any soybeans to China, even though the soybean marketing season has now started. There's also the perennial question of tariffs. Will tariffs stay the same? Will they be lowered? What's going to happen on fentanyl tariffs? So, I mean, yes, TikTok is obviously going to be the primary focus, I think, of people as they're listening to what's happening on the call. But there is so much other things, so many other issues and points of tension between China and the US right now.
OK, Bloomberg's James Mager joining us, of course, on the ground for us in China with what to think about ahead of this call between the two presidents. TikTok, just one element, of course, in terms of the source of tensions between those two nations. Now, Intel shares, technology is certainly a question mark as well in terms of US-China trade relations. And Intel shares soaring yesterday after Nvidia agrees to invest $5 billion in the chipmaker. Nvidia's CEO, Jensen Huang, says the deal presents an opportunity that could be worth $50 billion a year for both companies.
We thought it was going to be such an incredible investment. This is a big partnership, and we think it's going to be fantastic for Intel. It's going to be fantastic for us. And we're building revolutionary products that's going to address some $50 billion annual market. And so how could we, on the one hand, be excited about the products and how revolutionary they are, on the other hand, not be excited about the opportunities ahead? And so we're delighted to be a shareholder. We're delighted to have invested in Intel. And the return on that investment is going to be fantastic.
Let's bring in Bloomberg Intelligence senior analyst Rob Lee joining us for the context around this story. Rob, was this a political investment from Nvidia or a business decision?
OK, well, I like the way that Jensen sold it to us, because don't forget, he's a great CEO, a fantastic engineer and a superlative salesman. So I think the share price reaction says it all, really. Nvidia's stock was only up 3.5%. So it did rise, but the reaction on Intel was much greater. So this move certainly helps to shore up Intel's finances. Don't forget as well, I think the US government put in $5.7 billion recently. We saw another $2 billion come in from SoftBank. So at least that helps stabilize the business financially. But the major question here is about their growth outlook and, what strategic direction are they going to take? And I think on that front, there remains, very large uncertainties. And to answer your question, yes, absolutely, there must have been some backroom maneuvering. President Trump and the White House tried to pull a few favors, because obviously Intel in years gone by was the stalwart of the US semiconductor sector. And given the backdrop of geopolitics, obviously, even under the Biden administration, the US is trying to bolster and rebuild its semiconductor sector, and Intel really does lie at the heart of this. So financially, at least, the business is secure. It's been thrown a lifeline. But where do we go from here? Are they going to pursue the foundry line? That's going to be difficult with TSMC as the main competitor. Intel's lost the technology lead there many years ago. I would say probably on balance, they're more likely to go down the design path. And then maybe that's why, from a business point of view, the likes of Nvidia are showing some interest. But again, $5 billion is, I don't know about chicken feed, but it's a relatively small monetary investment, given Nvidia is almost quite literally printing money at this point.
Yeah, for Nvidia, it's almost a rounding error, isn't it, in terms of this investment? But it does tell a broader story in terms of the alignment now when it comes to the semiconductor space and the role of the Trump administration as well. Rob Lee, thank you very much indeed. That's a story, of course, we'll continue to monitor, whether they do build out those foundries and whether or not they can secure some major customers as well for the foundry business. Now, to the UK, where the deficit has come in much higher than expected. The pound falling, gilts selling off. Let's bring in Alex Brazier, Investment and Portfolio Solutions Global Head at BlackRock. And Alex, given all of your wealth of experience, what a fantastic day to get you in on, even if it's a challenging day for the UK when it comes to the debt load. What kind of position do you think this puts the Chancellor in right now? How would you characterise the depth of the challenge?
I think it's a reasonably big challenge, but I don't think today changes it a huge amount. You know, the Chancellor was already facing something that a lot of governments around the world are facing, which is G7 rates have risen a lot over the last few years, and countries like the UK are now having to respond to that because the fiscal dynamics mean effectively need a smaller primary deficit than you used to run to ensure fiscal sustainability. And that was always going to require difficult political choices. Now, what's really interesting to me, I think, is that actually the market isn't really questioning the credibility of the fiscal regime. The more interesting development over the course of the year, which is also difficult for the Chancellor, has been that the market's effectively looking at how sticky UK inflation has been. And it's not really pricing that the Chancellor is lacking credibility in meeting the fiscal rules. It's pricing that it's going to be tricky for the Bank of England to hit its inflation target. And that, of course, is having a knock-on effect to the fiscal numbers because the market's pricing UK rates staying reasonably high into the next few years. And that, of course, is feeding through to the fiscal position as well. But, you know, having UK rates priced north of where the Fed's expected to go over the next few years, that seems a bit of a push. And actually, there may be opportunities in the UK front end. Some of our fixed income teams are leaning there. And if we get some good inflation prints over time, if wage growth continues to come down, some of those fiscal pressures could ease up a little bit. OK, there's a lot to unpack there. I want to start with the neutral rate, because you were kind of nodding to that in terms of the BOE's role in how they can move inflation down. I was speaking to Bank of America, their economist there, and the view was that maybe we get a neutral rate of 3.5%, and that's where it settles for the BOE. Does that seem a reasonable level to think about when we think about the neutral rate for the UK central bank? I don't think it's unreasonable, but you look at the Bank of England's own estimates of where the neutral rate is. That's kind of at the north end of those estimates. And given where interest rates are now, remember, unemployment's risen in the last year in the UK twice as much as it has in the US. And we're having a market focus on a weak labour market in the US and potential for sharp rate cuts. Here, we've got unemployment rising, wage growth easing, but we've got pretty stubborn underlying services inflation. And I think the Bank of England's waiting for more confidence that all those other developments in the labour market are feeding through into underlying and core inflation. But if that happens, we could see estimates of the sort of near-term rate path and the neutral rate begin to be revised down somewhat, and that would ease some pressure on the Chancellor.
And with those caveats then, your base case right now is it sounds like you think the BOE can go again at some point this year.
I don't know about this year. I think it's going to be waiting for more evidence. It's looking to be pretty confident that underlying services inflation is coming down. But should that evidence emerge towards the end of the year into early next year, I don't think it'll just be that we get more rate cuts early next year. It could be that people actually look at their estimates of the neutral rate at that point, and that'll then feed back to the fiscal position as well. And
you talked about opportunities that may be found at the front end of the yield curve here in the UK. So at 3.96 right now, just shy of 4% on the 2-year. What then is the House view on where yields settle at the front end?
I don't think we have a firm view on where those front end yields settle. We're looking at, how much will it take to bring down underlying services inflation? Yeah. But the balance of risks at the moment seems to us to be to the downside to those short end yields. So fixed income teams have been adding to front end gilt positions as this market's developed. I think at the long end, we're going to see a lot of volatility. We've seen it this morning. The market's very sensitive to individual numbers on the fiscal policy is effectively at the fore. But with UK yields where they are, 10-year, 30-year, you've got a reasonable term premium in there. You've got a pretty high neutral rate underlying that as well. So for investors who can tolerate the inevitable sort of choppiness and volatility through the news flow, long-term investors, maybe that presents an attractive opportunity as well.
Talking of the news flow, we have the budget, of course, coming up in November. And in your first answer, you kind of shifted the focus a little bit away from the Chancellor and towards the Bank of England. Does that suggest then that the market is going to be less sensitive to the November budget than maybe we had assumed? What is the sensitivity around that event, and what are you starting to think about in terms of the potential outcomes from?
Yeah, I mean, I think there's a lot of sensitivity around that event. I think it's the feedback loop between the monetary side and the fiscal side that's interesting, because stickiness of underlying services inflation has caused people to revise up neutral rate estimates for the UK. That's then having a feedback to the fiscal position. I think that's going to persist over the next few months. It's going to make the budget an important event in terms of what political choices the Chancellor makes. But I go back to this point that the market doesn't seem to be pricing a lack of credibility of the fiscal regime. There are really interesting questions about how the Chancellor achieves that. They're political questions. For markets, it seems to be much more about the Bank of England and the neutral rate than it is about fiscal credibility.
I want to get to your views on the equity markets right now. There's been a lot of tech investment news in the UK over the last few days with Trump's state visit. JP Morgan Asset Management putting out a note saying and warning that maybe disappointing earnings from the AI theme, from AI companies, or at least companies that are lent into AI, is a bigger risk for the equity markets than geopolitical tensions. How do you think about the risks around AI being able to deliver?
Well, I would say two things on that. One is clearly the equity market is priced for strong earnings growth around the AI complex. So in that sense, it's more of a risk factor for the equity market than, say, geopolitical risks. But actually, we're pretty confident in those earnings potentials. You look at valuations of big tech companies, they're consistent with forward earnings growth of the order of 15%. That's actually something of a slowdown from what we've seen recently. And given the likely pace of build-out of AI infrastructure and, really importantly, the use of AI in the wider economy, actually, we are pretty bullish about US tech, about US earnings, and about the prospects near term for US equities more broadly.
OK, you're pretty positive on that front, and the earnings and the valuations aren't looking too problematic for you. When it comes, the earning differential between what's happening in the US versus Europe is still pretty pronounced, and yet you do recommend allocating some capital, or at least you're starting to see your clients continuing that theme around allocating capital to Europe. Where should that be targeted?
Yeah, I think two themes here. One is I think clients have looked at the first half of the year and seen not that Europe's been driven by earnings growth, but actually for them Europe has outperformed the US because of the currency. And people are looking now at hedging some of that currency risk. We've seen hedge ratios go up, and we've seen clients look to increase on the margin some of their exposure to Europe, I think for that currency reason. Where they do go into Europe, we're looking at exposures like financials and the build-out of the defence spend. We've seen it feed through to some of the direct implications, but not more broadly. But I think this dollar question is really interesting for portfolios because it kind of reflects uncertainty about what the Federal Reserve's reaction function is. Like, what weight is it going to place on the labour market slowdown versus the unemployment rate, which, as I say, hasn't gone up as much as it has in the UK, versus reasonably sticky inflation. And right now, the market's pricing a pretty dovish Fed. Now, if we get sustained growth in the US and a pretty dovish Fed, actually, that could lead to a further depreciation of the dollar. Our tactical teams are positioned that way. And for portfolios, this question about central bank reaction function is leading to a pretty sort of unreliable stock-bond correlation. And so lots of investors are coming to us and looking at how do we build resilient portfolios for that? And they're turning to strategies like liquid alternatives that are much more uncorrelated with the broad market to diversify income streams in portfolios. And I think that unreliable stock-bond correlation is actually leading to some pretty profound changes.
That's really interesting. That's something we should explore in more detail at some point. Alex, fantastic always to get your views on all things UK, of course, the BOE, the fiscal situation for the Chancellor, and the tech theme in the US, and how to think about allocating to Europe as well. Alex Brazier, Investment and Portfolio Solutions Global Head at BlackRock. Just zeroing in on one stock right now, FedEx. This was certainly drawing some attention yesterday. They came through with a note, or at least the earnings update, and there is going to be a hit from tariffs for FedEx. They were pretty clear about that, about $1 billion. But you are seeing a jump in terms of FedEx's stock price pre-market, of course, pointing higher by 5%. So the company coming up with some slightly more positive earnings in terms of the numbers, but that warning, of course, on the tariff impact. Despite that, Again, pre-market, FedEx pointing higher by close to 5%. Coming up, has Starmer's flattery of Trump paid off? We're going to speak to Chatham House's Laurel Rapp about whether Trump's historic second state visit has really supercharged US-UK cooperation. This is Bloomberg. Welcome back. President Donald Trump and Prime Minister Keir Starmer concluded an historic state visit by praising the transatlantic relationship and, at least publicly, soothing over their policy differences. It was exactly the kind of response UK officials had been hoping for as Starmer hailed a, quote, record figure of £250 billion in bilateral tech investments. You could almost hear the sighs of relief in Whitehall on the back of this state visit being a success, at least on the surface. Joining me now is Laurel Rapp, US and North America Programme Director at Chatham House, to dig a little bit deeper into the meanings of this, the consequences. How significant do you think this visit really was materially for the relationship between the US and UK?
By all measures, it was a very successful symbolic trip over the past couple of days, and it had the added value of carrying with it a number of substantive policy deliverables, particularly in the technology sector. There were some pretty major announcements in the £31 billion amount, and this is going to bring dividends for the UK economy across the country.
Is when it comes to those technology investments, can we characterise this as a pivotal moment in terms of US-UK relations and the depth of investments, or is it just another move in what has already become a closening of that security and tech alliance? I mean, how significant is this really? Does it change the dynamic when it comes to the relationship between the US and UK when it comes to technology?
Look, we've seen a lot of investment over the years and the decades in the technology space. The UK is a very attractive market for the United States. Its regulatory market is better than most. It has a very trained and well-educated workforce. It has world-class research institutions. So for a technology ecosystem, it makes a lot of sense for the U.S. The announcements we saw over the past days were big. They are not as big as some of the huge announcements the White House has made and other U.S. tech companies have made in recent months domestically in the United States. In the $500 billion, $600 billion range. So it's not on the scale of what we've seen within the U.S., but from a foreign investment perspective, it's meaningful.
A lot of fanfare, of course, back in May when the UK struck a trade deal with the US.
Yes.
Remind us what part of that trade deal has actually been implemented and what remains outstanding.
So the trade deal announced was a huge political prize for the UK. This is a U.S. administration that pledged to strike 90 deals in 90 days. We haven't seen that volume yet, but we have seen about a handful at this point. The UK, as you remember, was the first country to secure that huge arrangement with Washington, although the details of that arrangement, it was a framework. It was a rough framework that would then be elaborated on and clarified and finalized in the months ahead. We were wondering if we would see more specifics on this arrangement on the state visit. We were also wondering if we were to see a timeline for implementation. We saw a little bit of that, but we don't yet have a sense of when this deal will finally be operative on all of its measures. A couple pieces are already in place, including on UK automobiles, but on one of the bigger pieces on the steel and aluminum tariffs that were pledged to be dropped from 25% to zero. Yeah. We saw in the final days before this visit that the arrangement to drop the tariffs had been dropped, had been canceled. So those tariffs remain in place.
On geopolitics, President Trump seems pretty immovable on Russia, the question of Russia and Ukraine, and the question of Gaza. Does this suggest that Britain's power to influence the US president on those aspects is waning?
On Gaza, Prime Minister Starmer's announcement coming in potentially as early as this weekend to recognize the state of Palestine has offered some limited leverage for the UK to engage the US on a viable and concrete path to bring about a ceasefire and a broader two-state solution in Gaza. My read of the Prime Minister's continued intent to do so over the weekend, which will undoubtedly anger the United States. It's something Secretary Rubio has said would embolden Hamas and others who seek to destroy a two-state solution. He may not have heard the assurances that he needed in this conversation yesterday at Chequers, that there is a concrete and viable plan coming in the days ahead.
I want to ask you about domestic politics as well, because it's been notable. There's obviously a lot of split opinion in terms of the cancelling of Jimmy Kimmel's show and what that tells us about the squeeze on the media landscape in the US right now, and criticisms that we're seeing a form of censorship in the US. That's the criticism from some. Let's take a listen to what the president has been saying about how he's thinking about TV businesses and news reporting.
I read someplace that the networks were 97% against me. I got 97% negative, and yet I won it easily. I won all 7 swing states, popular, I won everything. And if they're 97% against, they give me only bad publicity or press. I mean, they're getting a license. I would think maybe their license should be taken away.
Maybe their license should be taken away. When you put it in its totality, the rhetorical, legal and financial pressure on law firms, on universities, on NGOs, on political opponents, on the Federal Reserve and now on the media, how do you characterise that, Laurel?
So we are seeing a broader set of pressures brought on U.S. institutions in this administration as compared to the first Trump administration. And we've seen use of new tactics that are seeking to then, the intent has always been there, but there are newer tactics being used. And this is something we're seeing both domestically and on the international landscape to seek to advance goals and objectives with new tactics. So this is a very contested space. It is a space of great political debate domestically in the United States right now.
Does it concern you? I mean, I was a China correspondent from Bloomberg for 5 years. Some of this reminds me of how China's government operates.
The U.S. has always had a very robust sense of public debate and public discourse, and this moment in particular, we are having a lot of open conversations about what the best approach is to protect freedom of speech and freedom of expression. It's something that the president has come to the UK and to other countries and has expressed concern about how foreign governments are engaging with freedom of speech, which is complicating measures at home.
We'll see how that debate continues. Laurel Rapp, thank you very much indeed. US and North America Programme Director at Chatham House with that analysis. Coming up, we're going to speak to the Lord Mayor of the City of London about the investment pledges made during President Trump's state visit and what the city is expecting from the upcoming budget. That is next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. These are your top stories. TikTok's fates and trade tensions loom as Presidents Trump and Xi Jinping prepare to speak later. This as Trump expands his war on the US media. A record-breaking global stock rally cools after the Bank of Japan's decision to start selling its massive ETF holdings. Rates are left on hold after a split decision. Plus, gilts and the pound fall after UK government borrowing comes in significantly higher than forecast in a new blow to the UK Chancellor. Now, to the European Union, which is looking to phase out its use of Russian LNG more quickly after a push by President Trump. EU finance ministers are currently holding an informal meeting in Copenhagen. Spanish Economy Minister Carlos Cuerpo told us that the country is increasing LNG purchases from the US.
Spanish companies have increased substantially our purchases of LNG from the US, so somehow we're getting away from Russia, and it's good that we have a specific calendar, and if we can push ahead more rapidly, then that's good news as well. We'll be pushing from the Spanish perspective as well.
Well, Bloomberg's Oliver Crook joins us from Copenhagen, has been speaking to many of the ministers on the ground this morning. Ollie, what is your sense as to whether or not there is a collective agreement, at least rhetorically, to ramp up the pressure on Russia. What materially can those ministers do right now?
Yeah, what I think is interesting, Tom, is that with many of these conversations, it's the Trump administration that focuses the attention and the efforts of many in Europe. Obviously, he's come to the Europeans over the last couple of weeks with a couple of proposals ranging in kind of the variety of how extreme they are. But the first point that he makes, which I think is a fairly legitimate and self-evident one, which is how can you say you're putting maximum pressure on Russia when last year 20% of the gas, or about 19% of the gas that went into the European Union still came from Russia. Part of it in pipeline that was sort of carve-outs for Slovakia and Hungary, but a huge volume of that is now coming in LNG, like liquefied natural gas, and a lot of that is docking in Spain. So hearing from the Spanish minister on that, saying that basically they're open to this idea. They wanted to completely phase out Russian gas by the end of 2027. It seems now the Commission is pushing that forward by a full year. They want to get that basically out by 2026, and there seems to be some consensus building around that within Europe. There are, of course, a lot of negotiations that have to happen behind closed doors, namely with the Hungarians, who have been sort of opposed to this sort of idea for a long period of time. But then the second point is also a question about the Russian assets. This is the second point that Trump was saying. Basically, you need to start tapping these underlying Russian assets that we know have been held for a long time in Belgium by the the central bank and been dispersed the profits. Now they're talking about how to get to the underlying assets, and that is a conversation that will be very active for finance ministers. And I spoke to the Dutch finance minister about that a little bit earlier. Have a listen to what he had to say.
We already used those assets as a collateral to give loans to the Ukraine, and now we're going to see if we can use those funds even further. But it should be legally possible. It's a very complicated matter, but once again, all the options should be on the table, because let's not forget, it's Russia attacking Ukraine. Yeah. Ukraine needs our support, so those frozen assets should be used in the benefit of Ukraine.
So it seems that there is some consensus moving forward on taking more of those Russian assets or finding different ways to monetize that. There's the question of banning the Russian gas, making progress. Then there's the final Trump proposal, which was basically adding 50 to 100% tariffs on China and India for their continued purchases for fossil fuels. The U.S. says they're willing to do it, but the EU needs to go first. That is something that is far too rich for the Europeans. And I was just speaking with the Spanish economy minister, who sort of takes a different position on China, says that actually Europe should have a much better relationship economically with China, and was really sort of defending his tack there. And remember, it was in Madrid that held those conversations between the U.S. administration and the Chinese a little bit earlier this week. But I think that last proposal is probably a step too far, though maybe they'll draw some inspiration and maybe target some Chinese companies and Indian companies that are still working with the Russians on military and potentially refining of oil.
Ollie, how does this all tie in to the focus on trying to reshore this European economy, focus on sovereignty, focus on having supply chains that are more resilient, all these elements, innovation, technology that were part of the Draghi agenda, a single market? Where are we on progress on that front?
Well, I can give you a pretty precise figure on that, Tom. There was a report that was made out by one of the parliamentary groups a couple of weeks ago that said basically in the last year since the Draghi report was released, only about 11% of it has been instituted by the various EU measures that have been taken in that period of time. And we should say Mario Draghi sort of spoke this week to give his appraisal of kind of where things stand in Europe a year after the report was printed. And I'll just get you a couple excerpts there because it really makes for some fairly stark reading, saying that basically the deficit with China over that one-year period of time has increased by 20%. Investment requirements that he initially said that the ECB said were about 800 billion a year has now come to 1.2 trillion a year, because that is largely due down to defense spending that has boosted a lot in the last year, and that over the sort of next 10 years, the EU public debt is expected to rise another 10%. So there is a question about basically the reforms being a little bit too slow, but it's also the scale of the challenge itself is mounting as time goes on. So this is going to be a very active conversation for the finance ministers here. Of course, removing barriers within the single market is seen as a sort of most low-hanging fruit in order to juice up the economy a little bit, but potentially steps forward in terms of the capital markets union. The problem is, Tom, is that you have this sort of paradox in Europe. What Europe needs, if you believe Mario Draghi, is a more federated Europe, something where you're coming together, there's more power with the EU. At the same time, domestically, for many of these nations, as we saw last week in France, you have a much more nationalistic bent, and the money is is just not there. That is a paradox, though, I think, Tom, very interestingly, speaking to the Austrian finance minister yesterday, they're dealing with same fragmented politics, but they've been able to build a three-party coalition. They've been able to get things done and move things forward as potentially a model to get out of this sort of political paralysis that you have here in Europe. And I should say just a final thing. We also heard from the Austrian finance minister. He's one of the frugal four. This is the second of the frugal four that has told me in interviews over the last 2 years that they need to start thinking more actively and more openly about the idea of joint debt to try to tackle some of the scale of the troubles that Europe is facing over the next two. I'm still working on the Dutch and the Swedish. They're not there yet in terms of the issue of joint debt.
OK, interesting case study when it comes to the Austrians. Oliver Crook on the ground for us in Copenhagen with that paradox, of course, confronting most European leaders right now. Let's get back to the UK and its relationship with the US, because US President Donald Trump, of course, concluded his historic state visit to the UK by hailing transatlantic relations with Prime Minister Keir Starmer. The two leaders stressed their common ground and announced big-ticket investments in technology and energy. The Lord Mayor of the City of London, Alastair, joins me around the desk right now. Lord Mayor, thank you for coming in. Great timing, Alice, to talk through what has happened in terms of this relationship. How would you, looking at this state visit then, how would you grade the UK Prime Minister and his handling of President Trump?
Well, Tom, good morning. It's lovely to be here with you. It was, I thought, extraordinarily successful state visit. I think that the President comes away with good, warm feelings about the United Kingdom, and I think that he was, and I think some of the announcements that have been made in relation to the tech deals and all the rest of it. Those are pretty substantial deals, so we're pretty happy.
You've made a call. You've pushed for the City of London and the UK economy to lean in to technology. Does the UK-US tech deal that was announced, does it move things in the right direction? How significant do you think it is? Does the UK win from this deal?
I think it does. It's a good deal. I think there's some good aspects to it all. I think we've got to make sure that we're monetising the extraordinary data databases that we have here in the United Kingdom that go back many decades in some cases. Very few countries have the same sort of rich wealth of data that we have. And I think with the large language models and all the rest of it, these are the sort of things that are so important. And I just think there was an extraordinary desire to collaborate between the large American tech companies and also counterparts in the United Kingdom, and it's wonderful to see that actually being inked in a deal.
What would you say to the critics who say we risk becoming overly reliant on US technology?
Well, I think we are. Bear in mind that the United Kingdom doesn't do badly in relation to its technological base here. We are, the United States and the United Kingdom are the only countries in the free world that have $1 trillion economy when it comes to those areas of activity. Look at our strength in fintech. Look at our strength in AI. We're number 2 or number 3 in the world always in those sorts of areas. So I don't think the United Kingdom does badly. We certainly punch above our weight.
I want to get your views on the fiscal constraints that this UK government is facing right now. With a beating heart, the City of London, of course, front and centre. The budget deficit, we get a reminder of the pressures there today, with that number coming in well above the OBR's forecasts. So that brings us to the budget in November. Given the constraints, would it be reasonable for this UK government to pursue a surcharge on banks?
Well, look, I mean, I don't get involved in the specifics in relation to the options available to the Chancellor, and that's something that is very much her and the Treasury team. I think what I would say is that the government want growth. The City of London and the financial, professional, legal, maritime services sectors, which are the sectors for which I have the great honour to be the global ambassador, that's the place where it's sort of near and middle term growth will happen, because effectively the buildings are already built, the people are already trained. The missing ingredient is confidence.
And a bank surcharge would be unhelpful.
Well, I mean, I just think I would. Again, I'm not going to go through this individual sort of areas. That's entirely up to the Chancellor. But I'm just saying, how can we instill more confidence in the United Kingdom's financial, professional, legal, maritime services sectors? Because there's latent sort of a potential there, and there's such strength in depth in what we do. And I just think let's work out how do we get more confidence into the system.
You have your ear to the ground. You're talking with policymakers. You're talking with business leaders. What is your best guess as to what comes out of the budget in terms of some of the top line moves that this Chancellor may make?
Well, I mean, I think what the sectors need is a degree of certainty, long-term certainty. Here are the fiscal provisions. And I think the idea of my request to them would say, look, can we actually work on a principle that this is what's going to pertain over the next few years? Because you can then, if you've got that sort of perception of what's going to happen in the next few years, you can then make some capital budgeting decisions off the back of that. I do think there's some sort of there is a desire to do more. I see real sort of opportunity in relation to the United Kingdom's financial, professional, legal, maritime services sector. There's a willingness to do more, but they just want some of that uncertainty to be taken off the table. What
is the mood in the City of London right now? We're a little over a year into this new government. How are they grading the government right now, the grandees of the city?
I think that there is some. We see the opportunity. I've been really pushing in relation to getting a bit more risk back into the system, because effectively, we are. The analogy I've used before is that we are, the world's best sort of striker in soccer terms, or whatever. But we've lost a yard of pace, and I've been trying to sort of claw back as much of that yard of pace as I possibly can during the course of my term. I do sense that there's been some really good wins. We've had something called the Mansion House Accord, which is coming together with 17 of the largest pension funds to say that they'll invest up to £100 billion in alternative assets over the course of over the next 4 years.
So city bosses are not coming to you with their heads in their hands right now?
No, I don't think they are. And I think also the other element is that there's been some real movement in relation to regulatory change. I think certainly the perception is that the regulators are starting to move in relation to taking on the competitive environment and the competitive objective. So there is movement.
We have to talk about the changing political sands as well here in the UK, as we have done in Europe as well, and the popularity of parties like Reform UK. Are you seeing any evidence of city firms and executives moving closer to Reform UK? Is that relationship becoming deeper?
I'm sure it is. I've seen I've heard anecdotal evidence of that being the case. And I think companies have got to make sure that they keep a finger on the pulse as to what's going on, and they've got the relationships going. So I'm sure that's occurring, not necessarily in the full glare of publicity.
You think a lot about jobs in the City of London. The shrinking UK stock market, to what extent is that a risk to jobs?
I think I go back to this point of confidence. Effectively, the idea of seeing companies delisting doesn't do wonders for confidence in the market. Having said that, I think there have been some really substantive reforms in the listing rules in the London Stock Exchange. I think that there is an awful lot of work has been going on. They've an enormously innovative program called Pisces, which the London Stock Exchange have implemented. All these things, I think, go the fact that and the pipeline of companies coming through that are going to list is, I understand, pretty strong.
What are overall job numbers looking like in the City of London right now?
Well, I mean, it's something I always mention, is the fact that at the time of the Brexit referendum, we had 525,000 people working in the square mile and the financial district here. Last time we counted, which was at the back end of last year, we were up to 678,000. If you add in Canary Wharf, it's the Financial Professional Services Centre, and the hedge fund area over in Mayfair, you get up to a figure of about 880,000 people who are in financial professional services in Greater London. You compare that to the total population of Frankfurt at 723,000.
Yeah. And those numbers continue to rise?
Yes, they are, absolutely right. And so we are, and bear in mind, you compare that again to the projections that we used to see at the time of the Brexit referendum, that the city was a busted flush. It's extraordinarily resilient because there's a real centre of excellence here.
Just briefly again on the stock market travails in the UK, to what extent is that a headwind when it comes to those startups that I know you're focused on in the tech world in terms of their ability to grow and scale?
Yeah. It's a new situation because when I've scaled businesses of my own earlier in my career, I did so on the stock exchange, effectively on the AIM market. So it's sad that that's not available to entrepreneurs as it was to me. Having said that, there are some good companies on AIM, and they are able to sort of grow some money. I think there are some more companies coming in, and I think what can we do to get the confidence in order to get some more investment back? I think also, bear in mind, I mentioned the Mansion House Accord. I was great privileged to bring that into and sign it with the Chancellor. That the AIM markets are part of that Mansion House Accord, so therefore we could see, I would hope we will see, large amounts of additional capital going into the AIM market through that route.
OK, let's see if that happens. City of London Lord Mayor Alastair King, thank you very much indeed for joining us.
Good to see you.
Around the desk. All right, coming up, Bank of England Governor, we're going to stick with the UK. Andrew Bailey indicates that more rate cuts are to come. It's all about a question of timing and scale. We'll find out why he has made that assessment. Catch up on other central bank moves this week. That is next. This is Bloomberg. Bank of England Governor Andrew Bailey indicating more rate cuts are to come, saying rising inflation and an easing labour market are still risks. The MPC voted 7-2 to keep rates on hold at 4% yesterday. Markets have all but ruled out a cut at the next meeting in November. The central bank also stepped down the pace of quantitative tightening following concern over bond market volatility.
We take into account all market conditions. So any effect that our sales have on market conditions and therefore on interest rates going out along the sort of the whole maturity spectrum of interest rates, we will take into account when we set bank rates. So there would be an offset there, in other words.
OK, let's get a market view right now and bring in Ven Ram, cross-asset strategist at Bloomberg N Live. Ven, you always have a close view, of course, on UK assets, and you're thinking about monetary policy very closely. The gilt markets today don't look overly concerned, and this despite the fact that we have had a BOE that's kept on hold, the pricing, of course, through the end of this year, and a budget deficit overshoot. We get a reminder of the fiscal constraints of this UK Chancellor. Why do you think gilts are behaving relatively well today? Do you think that's going to last, Ven?
Morning, Tom. I think that, there's plenty to explain the behavior of gilts this morning. Yields have nudged higher today, and gilts are underperforming European markets. So there are a couple of reasons. One was the fact that you mentioned that the Bank of England is hinting at cutting rates down the line, which Governor Bailey did yesterday afternoon. But if you look at the inflation dynamics in the UK, Tom, we have had one reading in the past 4 years. We've had one reading where headline inflation has been below 2%. So they've been missing the inflation target for 4 years in a row now. And inflation is threatening to accelerate, as we have seen in the latest prints. And that means that the Bank of England would run the risk of running a real negative policy rate if they cut rates any more. So the wiggle room for the Bank of England to be cutting rates is very little here. And they are skating on thin ice if they are thinking that, they can afford to cut rates here. The inflation markets are suggesting there is just simply no room for them to cut rates. So it would be a policy mistake for the Bank of England to be cutting rates into this environment, which is why you're seeing front-end gilt yields holding near 4%, even though that is hugging the bank rate very closely. So that is a measure of skepticism. The long end, Tom, has also been selling off because of the Bank of England yesterday said that they are going to sell less of gilts. But that also means the flip side of that argument means that they are going to hold more of gilts on their books. And because they are paying a higher interest rate on those bonds than what they're getting from it, it means that the fact that the Bank of England's losses are indemnified, it means that all the risk has been transferred to the Chancellor's office, and that means a bigger headache for Chancellor Rachel Reeves when she unveils the autumn budget, which means that she has to plug an extra gap stemming from the BOE's losses that arise from holding it on its books. So it's not looking very great for gilts at the moment, but let's see how that story evolves as she presents the autumn budget.
OK, and then briefly, you've been looking at the cash savings of British consumers. And we're saving less. Is that because we're earning less, we've got lower incomes, or is it because we're becoming less cautious, we're more willing to spend?
I think the answer, the brutally honest answer, Tom, is that, there is very little wiggle room for the consumer. On the one hand, as we just discussed, inflation is running amok in the UK and is not a target, which means that the purchasing power has been continuously eroded. And on the other hand, Reeves is going to have to put up taxes in the autumn budget, which means that, there's fiscal tightening as well. And, the consumer is caught between inflation that is running amok and he or she is asked to pay more taxes by way of taxes as well. So that leaves them with very little room to save any money. And that's the predicament that the survey is pointing out to.
OK, Ven Ram, cross-asset strategist at Bloomberg M Live, not leaving us on the brightest note this Friday, but smart analysis as always, Ven. Thank you. Now back to the tech story right now. Nvidia planning, of course, to invest £2 billion to support the UK's AI industry in partnership with several venture capital firms. It's one of a slew of AI announcements from US tech firms this week, coinciding, of course, with President Trump's state visit to the UK. So what does this all mean for Britain's AI ambitions? We're joined now by Palmy Olsen from Bloomberg Opinion, who is, of course, thinking about UK and European tech for a long time with all that analysis. Palmy, when you think about the deals that have been done, and particularly the investments in the UK from Nvidia, are we now better positioned in terms of our AI ambitions than we were a week ago?
Yeah, I think all these investments into infrastructure for building AI are important. My concern is that it becomes a little bit of a distraction from what Britain really needs to do to try and, if you will, try and close this gap that it has with the U.S. and with China. First of all, when it comes to infrastructure, Britain is very small on the scale. The U.S. accounts for something like 75% of all supercomputing capacity for AI. Even China's like a distant third from that at 15%. The U.K. is at about 3%. So all these huge numbers actually are, like, in the grand scheme of things, only moving the dial a little bit. But there's still a really great opportunity for businesses here, particularly entrepreneurs, tech startups. There's so much innovation in this country. When you think about it, we had Alan Turing laid the foundations for the AI field itself. Tim Berners-Lee invented the World Wide Web. The difficulty in this country is commercializing it at scale, and that's what Silicon Valley has done so well. But there is an opportunity to build businesses on top of all this infrastructure that U.S. companies are investing in that is so expensive, rather than trying to match that infrastructure.
But do we need to do both? Do we need the infrastructure and the applications on top? Are you pointing to potential misallocation of resources?
Perhaps a little bit. I think some of the investment that's going into there's different types of data centers. There's data centers that are meant for AI training, and there's data centers meant for AI inference, which is running AI models. And a lot of the government-backed investment is going into AI training data centers, which is fine. Maybe the UK will have its own DeepSeek moment that China had, where it'll someone here will invent a model that's very efficient and can actually go toe-to-toe with ChatGPT in terms of capabilities. But that seems very unlikely, and it makes more sense to invest in infrastructure that can run these models. And so for that, we really just need more funding for startups here who want to grow big. This is an age-old issue in the UK tech ecosystem, which is that startups can raise money in the early stage very easily, no problems. Yeah. But when you want to get big, you have to go to SoftBank, you have to go to the US. The pension funds in this country and across Europe just aren't backing venture capital, and that's what we need to see more of.
The growth capital conundrum that remains for the UK. Palmy Olsen, always excellent, of course, on the tech ecosystem. From Bloomberg Opinion and author of Supremacy, AI, ChatGPT, and the Race That Will Change the World. A must-read as well. Now, former St. Louis Fed President Jim Bullard will be joining Bloomberg Surveillance at 12:30 p.m. UK time. Tune in for that interview. Views, of course, on the Fed moves. Stay up for that. Coming up, Bloomberg Brief. This is Bloomberg.